Welcome back to the Spatial Show. I am one of your hosts, Elliot Golan. By day, I am a senior vice president and co-lead the real estate practice at Allison, a global marketing communications and PR firm. Vlad, good to see you, my man.
Good to see you. My name is Vladimir Bosanac. I am one of the co-hosts of the Spatial Show here as well, and by day, the co-founder and publisher of the Registry, a West Coast commercial real estate news organizations. Elliot, how's it going? Casual week, casual Thursday here at the headquarters of the Registry. If you can see through the
Yeah.
through the camera.
Yeah, I mean, as a guy who's worked from home more or less exclusively for over a decade, it's always casual day. But yeah, I appreciate that. I like that. It's kind of the Bay Area thing too, right? Like I'm just wearing a hoodie. Um,
Yeah, or I'm just doing a hackathon later this afternoon. Either or. We'll we'll see. We'll see how it
Fantastic,
goes.
fantastic. Well, today we're going to hear from Neil Schimmel, excuse me, founder and CEO of Investors Management Group, multifamily investment and management firm. He's got some really interesting things to say about the market and kind of the ongoing conversation about rent growth and where opportunity lies, distress in the market. And then we actually get into a little bit of discussion around the COVID moratoriums that were obviously, massive news. So I think it's going to be very interesting for our audience to hear. Before that, as usual, run over some headlines. Today we'll cover a few of the kind of latest and greatest things. One will be around kind of financing and the latest on proliferation around continued CMBS surge. Also, the latest on the return to office and some new numbers and some anecdotes as well. And finally, because we can never get away from it, the never-ending saga of housing. And, Field of Dreams inevitably comes to mind every time I hear the topic of housing. The if you build it, they will come.
Yeah, they certainly will. Hey, speaking of something being built, I know you're still kind of feeling your way around AI. Have you been playing with this latest ChatGPT model that can kind of draw in any cartoon style? Do you have a favorite cartoon artist, maybe?
Oh, wow.
Um,
I didn't even know
yeah.
that. Well, I'm gonna admit something, Vlad. That's gonna really show the type of luddite you're dealing with. I have never navigated to ChatGPT's website, let alone utilized it. My wife has the app, and she asks it questions pretty regularly. I have not used any of that stuff in the year or two or however long it's been that it's kind of been the topic, the cool kidding class.
Well, there you have it. There you have it. Well, just so you know, this is where the cool kids have been playing over the last week or so. Apparently, they've released a new model, and you can upload a photo of yourself and basically tell it, "Hey, redraw this in the style of whoever," right? And so apparently, there's a very famous Japanese cartoon artist, Studio Ghibli
Ghibli,
or
yeah,
Ghibli,
yeah, yeah,
however.
yeah.
Yeah. So a lot of people have been using that and redrawing themselves and kind of doing that. I've jumped into the fray and used one of my cartoons that I grew up with. This Belgian comic called Tintin. Anyway, so I had myself drawn in that style. So I thought I'd see if you've ventured into this space, Elliot. This might be one of the reasons that you do it.
I mean, it's that type of totally irrelevant but entertaining sort of application that I'm all about. So this will likely get me over the hump.
There you go. There you go.
So financing capital continues to be an issue, and we've talked at least two times, maybe three by now, around CMBS, and we've suggested it was going to be, an ongoing story, and it's reaching some record numbers. Well, there's three bits of CMBS news in the last, I believe it's 10 days or so, and these are big numbers, and perhaps most importantly, these are big players. So, first of all, Vornado, of course, the iconic New York landlord, secured 450 million in CMBS at a 6.5 fixed rate. So not cheap money by any means. And then on the other side of the spectrum, which shows you some of the inconsistency here, Ares secured 564 million floating rate CMBS. So it really is the Wild West. Meanwhile, the last bit here, Pembroke, Fidelity's office ownership arm that spun off years ago, they actually had some CMBS loans sent to special servicing. So, I mean, between these three names, I don't think calling them all institutional is anything other than accurate.
Well, it's interesting that you think 6.5% is expensive money. I wonder what you can get from a regular lender, right? For this kind of loan, I don't know if 6.5% is even achievable. In this day and age, I think it also speaks a little bit to the sort of circumstances and the kind of general wait and see approach across not just this industry, but maybe the economy in general,
Yeah.
where people are really trying to figure out, okay, what's going to happen for the rest of the year. And the only lenders that are active, if you can even call them lenders, are some of these securitized folks. And I is this the end of the road? Is this the only lender available?
Yeah.
That kind of begs the question, why are they all of a sudden doing it? And does it spell trouble in the future? I don't know. All kind of questions that I'd love to have answered. But what I mean, you're obviously puzzled by it as well. So what are your thoughts?
Well, I'm not sure if I'm prepared to say it's bad news, but I am prepared to say it's not good news. So I think at best it's net neutral, but likely veering towards slightly negative and concerning. The most interesting part about this, aside from the three names being sort of A-star companies here, is that you have Vornado looking at fixed rate, which suggests some, unless there's an other investment vehicle fueled reasons, suggests that they are worried that interest rate could get worse. Whereas Ares is going with the more classical that we're used to seeing in this space, which is floating rate, right? Betting on the market. So right now I'm paying high, but you know what? I expect interest rates to go down so my rates can get better over the term of the loan. So, and we've seen this in the last few years, this notion of fixed rate because we have no bloody idea what's going to happen next, starting to become a thing again. Meanwhile, Ares is of course going floating rate. And I think that is a telling difference here, that these two shops are approaching it from this entirely different way.
Did Vornado specify which assets were part of this loan package?
Yep. Yep. Some trophy New York office right on Times Square. I mean, so
Okay.
so we're not talking about Class B properties that are in trouble here. We're talking Vornado's never going to sell these properties. I mean, this is hold forever.
Yeah, and a little bit of San Francisco news on Vornado is they are the co-owners with the Trump organization of 555 California, which is the former Bank of America
That's right.
trophy asset to downtown San Francisco. So I don't know. I don't know if they know something that we don't know, but it is. I'm going kind of meta here a little bit, but it is interesting that they are obviously tapping into this market, and I wonder if we're just at the point where they need to sort of recapitalize some of these assets,
Yep.
and this is the best they could get in Q2, Q1, end of Q1, sort of Q2 in 2025. But yeah, I mean, we talked about Hudson Pacific,
Right.
last week.
Right.
So big institutional folks, big numbers, are putting in billions combined, not
Right.
individually, into this space. It could spell trouble. I don't know, but we'll see. Certainly, we have a little bit of redux from '08 in terms of what CMBS can
Sure.
do, right?
And a lot of it still, and you notice in the names we're mentioning here, it still hovers around some of the asset class issues that we've been talking about. And
Yeah.
some news from this month. So Nuveen, which for those that aren't aware is a subsidiary of the insurance giant, TIAA, so certainly people with money, They sold a building in DC, 2 blocks from a metro station, a well-located building in DC, at a 76% discount. You can buy an office building in DC for $20 million, which obviously a lot
Yeah.
of money for mere mortals. But when you think about office buildings near a metro station in DC, that number should be very alarmingly low.
Yeah. Yeah,
Um,
we're seeing this. We're seeing this across the board. I think we're still going. That is still going through the system where I think some of these troubled assets that have been extending and pretending for the
yep,
last 24 months are now basically realizing we can't do this anymore. We've noticed that on the West Coast, certainly in Southern California, we've seen those kinds of discounts. In San Francisco, we've seen in Silicon Valley. Seattle has been showing similar kind of signs. So I think all the major markets where office properties like this are having a difficult time filling up, this will continue to happen. I think probably for a little bit of a foreseeable future. I don't think we're done with this stuff
no,
yet.
not at all.
And so that does not surprise me. But at the same time, what we are seeing is that these folks, while they will dispose of a property at an 80%, 60% discount, they'll go in and buy a property at an 80%, 60% discount as well if they feel that it has additional potential. So it is a little bit of, I think, of like, trading horses
Yep.
here, which will, I think, characterize the market for the foreseeable future.
Yeah,
Right.
yeah, the veritable shuffling of the deck chairs, if you will.
For
And
sure.
last thing on the financing topic that I thought was also interesting, again, as we look at kind of some of these asset class topics, is Prudential, or PGIM, as they like to be called now, closed its first ever data center fund. And the price tag, the Austin Powers pinky, $2 billion. So again, we're looking at big players, big money, looking at office and going, I don't know. Looking at data centers and going, yes, please.
Yeah, data centers are going to be the darling of the industry, I think, for the next, I don't know, 5 years, maybe longer, right? I mean, it'll basically power the AI, whatever it's coming, revolution or whatever you want to call it. And I don't think that we're going to be doing any less with data. So I think data and energy are going to be two areas of significant expansion over the next, I don't know, 10 years, 5 years at least.
Yep.
And so I can see big institutional folks, doing more of this, and it certainly is a growing part of the commercial real estate landscape.
And the latest, of course, on our favorite topic, return to office. So TREP put out a report. Speaking of our favorite extend and pretend slogan here, everyone said return to office is picking up. Everyone said office occupancy is picking up. We're turning a quarter. John Gray is now called the bottom, I don't know, 1,000 times. According to TREP, we're still 35-ish% below COVID levels. The office has not roared back, and I would even go as far as to say limping ahead is the way I would categorize it. Now, I am a naysayer, so I'd love to hear your thoughts.
Yeah, anecdotally, we've heard. Again, this is region specific. So, Northern California, anecdotally, I'm beginning to hear sort of stories that people are going back to the office. There's more folks in there. We are hearing that some of the newer organizations, new companies, new hires are not giving options of sort of working from home anymore, right? You're expected to be in the office 5 days a week. That's what I'm hearing kind of when I talk to brokers. I think the brokers will always present kind of a more optimistic, perspective on this. I did dig into some Castle Systems data. They are a little bit lagging. So the information that we have here from Castle Systems is basically showing the second half of March, the last 2 weeks.
Okay.
If you compare 2025 kind of, year to date to 2024, 2023, we're definitely up. So the peak days 2023 used to hover, I would argue, somewhere between kind of like 55, 56%. In 2024, the peak days would hover around 60-ish percent. Now the peak days are hovering kind of in the 63%. So it's moving up, but it's not moving way up.
Right.
We're not looking at numbers that are significantly higher, right? Across the sort of 10 city average occupancy, and the 10 cities that Castle System tracks is Austin, Dallas, San Jose, San Francisco, Los Angeles, Chicago, Philadelphia, Houston, New York, and DC. The weekly kind of average is about 53.6%. So, Class A seems to be different than sort of average occupancy in other sort of, other than Class A, right? So in sort of the Class A buildings, it does seem to be higher, closer to 75% compared to sort of 53 in kind of others. Peak day occupancy in Class A plus buildings is closer to 93%. As opposed to that 63 number that I kind of gave you. So what does this tell us? Make the office nicer and we'll come to work. Is that how we should interpret that?
Well, that's part of it, but correct me if I'm wrong. My understanding of that data, it's 93% of the least occupied space. Meanwhile, we're still looking at roughly a national office vacancy rate around 19-20%. So this is only categorizing the space that is actively leased.
You're saying Class A plus is least occupied?
No. But the data that Castle pulls, I believe it's exclusively pulling from space that is considered leased. So it's not that 90+% of office is full. 90% of the leased space is full. You still have record vacancies to deal with.
That's a good question. I don't know how they interpret that. That could be the caveat that yes, of the stuff that is leased. Anecdotally, I can tell you the Class A plus stuff is probably better leased, more leased than other stuff in general. Sort of A property or B or C property. So I guess by directionally we can say that it's showing, the nicer the building, the more people are going to be there in general. But I'm with you. Yeah, we probably need to dig in a little bit deeper to understand, is this just for the lease space or is it for everything in general?
Yeah,
you're absolutely right.
Of course.
Anyway, but it does sort of tell the story. And we have seen this. There was a report recently, I believe Herman Miller issued a report that their business has done pretty well in 2024, and they're attributing that to sort of this innovation in office space. So the workplace strategy folks are looking at ways how to, make it more homey, make it more hotel-y, however you want to call it, right? And it does seem to be paying dividends. So just from those kind of anecdotes, nicer place, nicer design space, right, will tend to attract people more, right? So kind of interesting.
Yeah.
And then on the third topic that we were going to talk a little bit about here, Elliot. So one of the things that we've seen, here in San Francisco last week, we have a new mayor in the city of San Francisco. For those of you who are not keeping track of that information, Mayor Daniel Lurie has pulled up a number, a housing number that he would like to, see accomplished during his tenure. This is not a new number. It's about 32,600 new housing units. It's a number that popped up in the budget of his predecessor, but they are putting together some sort of specific kind of goals and timeframes and zoning innovation around certain districts and parts of the city where they can see this happening.
Right.
Interestingly enough, that's a very great thing. I am pro housing. I am pro development on personal level, right? I think certainly living in the Bay Area, I can attest from my personal experience that it's difficult to find affordable housing in general, and I think the more of it we have, I think
Yeah.
it'll make things a lot easier. However, at the end of the day, all of these plans, all of this zoning, the city still cannot make the private investors build it.
Right.
The industry has to come together and actually do this. And I'm concerned, quite honestly, that given sort of what looks to be kind of a high interest rate environment, an environment of continuously escalating construction costs that are driven by, lower labor, higher material costs, and things like that, is going to make housing even
Yeah.
more harder to produce. We're at an environment where when you talk to multifamily folks, some of them still say, "Hey, I can buy, an apartment building at 300-400 grand a door. It's costing me 700-800 to build.
Yep.
I'm not going to build for anytime soon." And I feel like I'm sort of like I'm we're in this sort of hopeless loop of this is just never going to get done the next 3 to 5 years, and it just kind of made me feel like the plans are great, but who's actually going to make a move and do something? What do you think
Right.
about this?
I mean, I question a lot of these, and I didn't follow the mayoral sort of campaigns in San Francisco. I've never lived in the city in my life. Um, but a lot of this sort of reeks of kind of campaign bloviation. Like, yeah, cool, we're gonna build these housing units because we need it. But at some point, someone's gonna have to say, "Show me the receipts. How do we actually get it done?" Versus marketing it. But I do want to jump back to one thing. You said 3 to 5 years. It's a big number. How do you how do you get to something like we have this dire need for housing and we're going to get none of it in the next 5 years? I mean, that's
Yeah,
bold.
yeah, and that's a very fair question, and I break it down this way. Basically, we're sort of halfway through 2025, roughly, right? Even though we're here in early April, but roughly, let's say, half of 2025. I think if anything happens, from a kind of a macro, point of view in terms of inflation and, recession, hopefully not, terrible, right? But let's say that kicks in, that probably won't be realized until, let's say, Q3, Q4 of this year.
Sure.
So we're going to get those numbers, I think, by the end of this year. If anything happens, that means the recession sort of cycles through itself over the next, I don't know, 18, 24 months. So we're already looking at, mid, 2027, right?
Okay.
Before like that happens. Then let's say the Fed and all these other tools that we have to kind of overcorrect and inflation, and God forbid, whatever happens with sort of elections and all of these other kind of things, right? Easily could go into, until that takes effect, we're looking at 28, 29. So here we are, we're early 25, mid 25. We're talking about 29, before any of this actually starts to take effect. And I am, genuinely concerned that, we just keep, creating an environment where building housing just never seems, not never, but for the foreseeable future does not seem like a viable option for any developer. And I just, that's why I said 5 years, and you're absolutely right. It seems like a long amount of time, and, you're good to question it. I just don't see like anything turning around any faster.
Well, that's fair. I mean, I can tell you, I have spoken with no less than five investors, managers, developers on the NMHC top 50 who have said zero this year. That's what they're going to entitle and or break ground on. Zero. I've only spoken to one multifamily player who thinks they'll break ground on something this year. So, obviously the investment market has some turmoil, everything has some theoretical turmoil, but the construction market may actually be the most in trouble. The cliche pencils down comes to mind.
Yep.
Um,
Well, I think for obvious reasons, when we look at who works in construction, when we look at, let's say, if we put any shortage of labor in that area, that's
right,
going to make it more
right,
expensive. Materials, I don't think are going to get any cheaper as long as we're, rattling kind of the macro economy with some of these tariffs and things like that. So, we are at a precarious, position where some of this stuff is just not going to get done. And anecdotally, from the stories that we've covered, again, our focus is West Coast, but I don't think it's any different across the rest of the country either. Most of the sort of residential projects that are getting through, planning, those, as you know, those, you know, uh, once planning gives you, the, permissions and stuff, right? Those last for 10 years.
Right.
You can now sell a project, an entitled project, right?
Right.
And we're seeing a lot of entitlements kind of going on the sales market. Most recently, we covered a story down in Long Beach, a huge project of over 600 units, which was approved. I think entitlements were approved in 22 or 23.
Okay.
Just hit the market. So 600 units. The developer's basically saying, "I'm not doing it. I'd rather someone else chase it down." Right. And this is just that one market. I'm seeing similar stuff in Seattle. I'm seeing similar stuff in Portland,
Yeah.
Silicon Valley and San Francisco also, right? And if they're all selling entitled projects, that tells you a lot, right?
Yeah.
So it is sort of unfortunate, and I feel that we are just getting into the cycle of the people that own properties, their valuations are going to keep going up
Right.
because there's no new product coming online, which just by extension is going to increase the value of the existing
Existing
product. Right.
stock. Yeah. Well, I mean, that's par for the course in the single family space. So I wonder if we're just going to see the multifamily space become very similar or even more similar because, as you know, most of the large home builders are publicly traded and they utilize land banks. They don't go through entitlement and hold hundreds and hundreds and thousands of acres on their balance sheets for 10 years while they deal with the locals. They have someone else do all the heavy lifting and then they buy it at the 1 yard line.
Right.
That's absolutely the way single family works. All of them, DR, Lennar, that's their game. I wonder if we'll just see more of that sort of proliferate in the multifamily space, where could we actually see firms founded and create business models that are roughly equivalent to being a single family land bank, but doing it on the multifamily space?
100%. That this is already happening, and our anecdotes and stories already support that. Most of the stuff that we're seeing is on the multifamily side, and so that is definitely starting to happen, and I think it's going to be continuing to happen for the foreseeable future, right? So. Housing will be housing will continue to be a challenge, unfortunately, and we see that lack of supply will continue to sort of be a challenge at the same time, right? Driven by some of the macroeconomic drivers here, and we'll see when that actually changes. My guess, again, you're well to question my 5-year estimate here, but my guess for the foreseeable future, 3 to 5 years, I don't see a whole lot changing in that space, unfortunately.
It's a rough conclusion, but I'm having a hard time to poke much hole in it. So I think you may be right. Um, but there are people who are confident, and I don't think all of them are just doing the real estate kind of let's bloviate and let's pretend the house isn't on fire while our clothes are burning. Um, One of them, and we'll go right to him right now, Neil Schimmel said it's going to be a big year for Investors Management Group. He sees opportunity, he sees investments coming. Not a developer really, so he's gonna, not have to deal with some of the construction costs. But we'll kick over to our conversation with Neil and Vlad. Always a pleasure.
Likewise, we'll see you again next
All
week.
right, take care. And here we are. Neil, thanks so much for taking some time to chat. I am very much looking forward to this one.
Thanks for having me, Elliot.
So, just give us the nickel tour, sort of who you are, and of course, more importantly, or just as importantly, what IMG is.
Um, I'm the founder and CEO of Investors Management Group. We've been together for about 15 years. I've been in the business since birth, so it's all I really know. I love real estate. I started out as a CPA, but after that period, I got into real estate. So I've been doing it a very long time. And about 15 years ago, I launched Investors Management Group, IMG, and we specialize in 2 and 3 story garden style apartments throughout the US. Um, we do everything. So we find the property, we finance it, we raise the equity, we do the value add all the way through the sale. And the way the company is organized, we also offer 1031 exchanges at the termination of the investment. Um, I got involved in that circuitously because I started as a JV platform, and about 2015 or 16, my partners now, who I started to work with, we became partners in 2018. Mark Gordon is the financial person, but Carlin Conklin came to work with me. She was specialized in 1031s. It was something that I wanted to do and she wanted to do because we have both been very invested in real estate, and we wanted to have a company that could actually operate our investments. And so from that period forward, we have developed a very prominent 1031 platform. However, we still do have JV partners. And we also provide high net worth investors the opportunity to come in with as little as $25,000 to these various investments through one of our TIC investments. And so we have a very active platform for our investors, for our tenants, and we really try to go through the whole cycle in the company.
Yeah, that makes sense. I mean, there's kind of always a demand for 1031. It's not really, so susceptible to certain headwinds. In multifamily, I mean, it's the asset, right? So, I mean, most of the conversation around multifamily seems to be, I guess, what I would call cautious optimism. But I'd love your take. Do you kind of feel the same way? I'm sure you were at NMHC. What were you hearing from folks on the ground who maybe weren't in front of a microphone and had to, smile and shake hands?
It's really interesting, Elliot, because you got all of us that are in the business, and then you got the investors. And the one interesting part is that if we look at a day and a moment in a time, to your point, the optimism, our business runs on optimism.
Right.
Uh, as it relates to the investors, they're like, "What about what's going on? What's going on?" And I always look at them and I say, in everything that we do, if we look at it in a day, you never know where you're at. In the long term, optimism in apartment buildings, I think, is a very strong thing to have, especially if you're in the business. But as people that invest in it over the long term, its performance has proven itself,
Right.
and especially if you have good operators. So the optimism that we're talking about in the marketplace right now was last year, slow transactions. Now we're looking at interest rates, which have taken a dip. You know, how it happened, that's a whole different discussion. But to the extent that rates have taken a dip, uh, uh, rents are very low, absorption is at the very tail end of it. um, there should be some optimism. I think the important part of that is to be positioned right in the right kind of assets in the right locations. And that's where all the work is being done today in anticipation of sellers. Because right now, a lot of the institutions are not really moving on their rights. They're trying to keep everything status quo, as we say, pretend and extend.
Right.
And so I think there's going to be some cracks here sooner than later.
Yeah, I mean, you mentioned pretend and extend, which is I feel like sort of other than saying something was a win-win, probably the second most overused thing in our industry. So I'm curious because I some have called me a pessimist. I prefer realist. Um, Last year there was not a whole heck of a lot of optimism, and we heard things about limited or actually zero rent growth, interest rates, et cetera, et cetera. So my question is, interest rates, yeah, they've come down, but certainly not by any significant amount. Pricing, we are starting to see some sort of quote unquote deals, if you will. I know that CMBS delinquencies around multifamily. There's recent report that it's hit a record high. We will see some rent growth this year, but I haven't heard anyone that says like significant, a lot of rent growth. So how can we reconcile interest rates that I wouldn't say recovering, rent growth that is ticking along, but optimism. So why is this year different than last year?
We're further down in the cycle. These timelines and the sponsors that have been holding on, and they got to hold on by coming up with money. And are they going to make it to the next 12 to 18 months when absorption will be at its end? So, there's a lot going on right now with all of these different variables that are shaky. However, that is the opportunity. So, when we look at low interest rates, and we can't bet on that. But if we look at rental growth, and if we look at things that hit the bottom line NOI, and we are priced in the same kind of IRRs that we've been looking at
Right.
over the next year or two, if you're acquiring those deals 3 to 5 years out, I think may look pretty good. And so we are very actively in the market right now bidding.
Now, how much of that bidding does sort of coincide with kind of delinquencies and maturities and every real estate cycle has this period and every asset class has this experience, which is it's like investment 101, right? Like buy low, sell high. I'm not telling you anything groundbreaking here, but there seems to be a ton of reports that the delinquency rate around multifamily is maybe hitting its apex. Maybe our distress in the market is kind of hitting its moment. How much of that moment are you paying attention to?
Oh, we're looking at it, I mean, like it's here. Because because you got to be in front of it before it happens. And so uh, we are looking at the people that we've been working with, and we are making sure we're getting our bids in now. We're getting in the rhythm of it. We are doing more submissions to our JV partners to get their pricing and see how they view things. And so we're doing that far more actively than we did last year because we're starting to see some things. We've got a few projects right now that we will certainly perform on if they're awarded to us because it's what we do and they're hitting the numbers that we got to hit and they represent what our investors want and it is the kind of real estate that we like to work on. So um, you really have to start to look today at what's on the market because the problem has been that people that need to sell right now will sell. If you're getting in a distressed deal where the banks or the equity or
Right.
other people are in it, the chances of getting people to go, it's a needle in a haystack, and it's not a good qualification of our time. So those will come to us when they're available.
Right.
The brokers will be the ones to bring them to us. They will have been the ones to do all the dirty work to get them to where they needed to go.
Right.
And it's really about relationships right now. And that's what we're really working on.
So looking at this year and maybe give me a little historical perspective if you don't mind as well. Do you guys have a kind of geographical focus? I mean, or is it just in line with sort of where it makes sense? In the last cycle, everyone was buying everything they could in the Sun Belt. That was just where people were going.
Me too.
So no, general geographic focus we like to own in certain markets, or are you just following the right deal?
No, we are very, very specific in our locations. We won't do a one-off anywhere. That would be chasing deals. We definitely chase markets, and when we see a market that we like and we get a good entry point, um, we usually will buy very aggressively during that period of time. And so, yeah, I do like the Sun Belt. I do like distressed markets like Austin, Nashville, because I think that those cities have a very good long term. I think they're going to be great. And so, in the moment, these are some of the most distressed markets anywhere. But I pointed those two out because I think the opportunity, once there's a good entry point, will be great. We also operate in Denver, Seattle, Portland, but a lot of the markets that we're going to look at are really predicated on job growth,
Right.
an apartment community, people that want to finance and buy and sell and rent. So we call that intrinsic value in our business, and that's what we look for. So we're going to be in the markets that we're in. We are certainly tracking other markets that we've always wanted to be in. And I think some of these markets have really provided uh, or will provide a great opportunity because basis is really a great cornerstone for our company and what we buy. And I think these people are going to have to start to reflect the market.
So talk to me a little bit about those markets you sort of want to be in. Without giving away the special sauce, right? I don't know if anyone listening is going to go ahead and say, "Oh, well, Neil's looking at this market. I better put my nickels there too." But what do you have your eye on outside of perhaps what everyone's been talking about?
Um, it's Elliot. I would like to make some sexy statement here. We are really good at what we do and staying in our lane. We have basically three principles in our company that we invest on, and we call it IPA: intrinsic value, price per pound, and affordability. So whether it's a market that I'm already in or a new market that I want to go to, intrinsic value means you can buy, you can sell, you can get people to work on the property. There's active tenants there.
Right.
Price per pound, per foot, and per unit, handicapped by the age of the property. But affordability is really the one the one metric that to me makes the most difference in where we invest. Many of the markets that we own in today, when we bought those properties, we were buying based on the income, 14 to 16% is what people were paying toward rent.
Right.
We had good run room. If we went up to 25%, it was still very affordable. And so those are the kinds of things that we're looking for. And to your point, what's the secret sauce and where are you looking? Jobs, good jobs, sustainable jobs. So that would be a very, very important aspect of it. Not new jobs necessarily, um, but that is the cornerstone of what we look at. But when you look and you go, this market has always had really strong employment. Historically, this is a dip maybe that they're having,
Right.
but the infrastructure and all the bells and whistles are there. And I'm physically at the properties with my director of acquisitions, Kevin Crook. It's just the two of us. So, we are there. We know where it's happening. We can feel it. And that's how we look for our inventory.
I think Austin and Nashville, I mean, two markets you mentioned make a whole heck of a lot of sense there because they are kind of experiencing this dip, and maybe you can get some good deals. But longer term, I mean, those cities are fine. They're great. People want to be there, so it's just a moment in time.
That's exactly what I'm saying. And I think the other aspect of those cities, if you go there, you're going to see people that are young,
Right.
middle aged, and old. And that's really important as well because that it means it has intrinsic value. I like to go to the same restaurants that my kids do. Okay. When I see a restaurant that we both are at, that's a good place.
Right.
It's not one or the other. And to your point, a place like Austin or Nashville, people are going there. They want to be there. They want to make their homes there. They're sticking, and makes a lot of sense to me.
So reverting back to the kind of the investment side, can you talk to me a little bit about your investors? Because you mentioned kind of high net worth and almost like retail level. Like you don't need to have millions of dollars to get in on some of these deals. What is your rough breakdown? What are we looking at in terms of institutional versus private office, et cetera?
When we started, it was exclusively, this is 2010 or so, exclusively JV partners. Later on in the cycle, you start to think to yourself, is this sustainable?
Right.
Do I want to get into a 2-3 year deal with preferred equity or JV, whatever? And that's why we pivoted. So right now, I would say that probably 40% of every property that we capitalize would be 1031, up to 50%, 40 to 50%. Investors would be somewhere in the ballpark of the other 50%. Within that 50%,
Yeah.
I would say that family offices or uh, aggregators, if you will,
Yep.
would represent somewhere in the ballpark of that 50%, somewhere in the ballpark of maybe 30%, 20%. We have traditionally our investor pool. Um, they want inventory, and so we are always faced with making sure that we can take care of them and not put too much money with a high net worth office.
Right.
So it's a balancing act, and we try to take care of everybody. We have relationships, and so we really are talking to our people frequently about that.
Talk to me a little bit about foreign investors. It's always been a topic. It seems to be, I've seen quite a lot of reporting that suggests we will see an uptick this year, sort of in foreign capital. Now, U.S. real estate as a safe haven is older than I am. That's not, I don't know why people are saying that like it's some novel topic, but nonetheless, what are you looking at? Are you seeking foreign investment? Are you seeing that as an opportunity for your firm?
Um, I see it as an opportunity. Um, I've never worked with foreign capital, but I got a quick little story for you. I was with a friend. I was with a friend of mine last Thursday. He was in from out of town. They have their own JV. Uh, they have several JVs that they work with. They're very aggressive. They have it within their office. He has a product that was in Houston.
Okay.
They put it out to 40 people. They got term sheets from three, all foreign investors.
Interesting.
Yeah, really interesting. And, he's saying London, Dubai, these different places. And that's ultimately the term sheet that he took was from a group out of London. And it wasn't easy. But, they went hard with him at the acquisition. But to your question, when he told me that, I had the same response. Was really shocked.
Yeah.
No, no term sheets from any domestic providers.
That is really surprising. You'd think at least a few shops would be interested in an asset in a city that's got a good solid upside.
I think the equity is a little, a little scared.
Yep.
I think that their investors are watching the first deals they do, and so they're looking for the home run.
Right.
There's not going to be a home run. But if you look at it as a business, reasonable returns, and you look at 3 to 5 years out, which a lot of these deals are 2 to 3 years, So you're right on that timing right
Right.
now. But that's where I think in the third and fourth quarter, people might pay up a little extra, be a little closer to a faster timeline because our business is time and money.
Right. Right.
So I think that's where the JVs will be very active. And I think that will be for our group something that we feel strongly that we can perform on. So then the question became from NMHC, talking to equity, what are your hurdles? And some people would just kind of stutter over it. And I go, no, I need to know that number so I can kind of see what I can measure here.
Yeah.
Uh, and then they would quote me 12 to 14, but I think they meant 14 to 16.
Yeah.
And by the time the deal got over, maybe it would turn to an 18, and there's no money as a sponsor to be in that deal. So I think that's where a lot of the current JV partners are starting to look at the money. They got to get their money out too. So I think a lot of them are looking in the third, fourth quarter, like a lot of us are, and saying, "Oh, we're going to push a ton out then."
Yeah.
And then then you got to look at your sponsorship, and who are you dealing with, and are they going to all their investors and pulling on, the last 3 years, have they been calling on money from all of them, or did they self fund whatever problems they had,
Right.
or are they just a perfect group of people? That's going to be for them to figure out.
Well, if you found the perfect group of people, please send them my way. Well, I want to pull on that thread just a little bit farther related to perfect. So there is this kind of optimism, like we've talked about. We can't pretend there are no challenges. It's not, this isn't Field of Dreams. We're not in that moment. If you build it, if you buy it, they will come. What are the challenges? What are people not talking about?
um, Well-intended politicians um, uh, putting policies on properties such as moratoriums. In the It's one of the things that nobody's talking about because a lot of people are, right now we're past the COVID moratoriums.
Right.
Well, those things went on for a couple of years, and now those same people may or may not be in those units anymore, but many of them were trying to stay in those units as long as they could. Um, and there was a lot of hope involved with that because of all the politics going on and votes and both. I'm not saying either side; it
Yeah.
doesn't even matter. But that also permeated the local and municipal level courts, sheriffs. So now the eviction, because now we have homeless issues.
Right.
Those evictions have been delayed. Then we have appeals. If you can get the appeal,
Right.
then you got a sheriff that you got to get out there. And in the overlay of some markets that have homelessness, they're not moving so quickly. And if you're in our business and you have variable rate loan and your taxes went up and your insurance went up and you can't get people out, um, you know, it's something that we see. The other thing that we see is that when you have that type of living situation where you have somebody that's a great tenant, that loves living there, and they're surrounded by other people that are in this fog, if you will, it makes it a different experience.
Right.
And the reason I'm bringing it up is I'm a real estate guy. I go to these apartments. I go everywhere. I walk every inch of every property when I go. And I get, you can see how the people are living and, how the balconies look and what the fronts look like. And so I think that, under a normal operating market where you have normal courts and evictions and everything else, people have problems. We're happy to work with people that have problems. That's our business, to, provide housing and upgrade the housing. And right now, with some of these dynamics that are going on, It's very, very challenging. However, um, therein lies the opportunity as well. So, it's a long-winded answer,
Yeah.
but
I wonder. There may be data on this somewhere. Actually, there probably isn't, but I'm curious. Using a massive operator, a gray star type. Hundreds and hundreds and hundreds of thousands of doors. I wonder what percentage of occupancy is sort of, I guess, let's call it, not real occupancy because it's not collecting occupancy. It's butts in chairs, so to speak, but they didn't buy the ticket.
um, yeah, Elliot, we focus only on economic occupancy.
Right,
That's the one we're focusing on. However, we look at that in relationship to physical. Um, we have been very aggressive about getting those numbers closer and closer together.
right, right,
As a result, several markets that we've been in, with the concessions and all the craziness, we kind of just looked at the net numbers and said, this is where we're priced out without the concessions. So now we can really look at what the numbers really are, and we can grow from there as opposed to playing this concession game.
yeah,
And so that was one of the ways that we tried to remedy that issue. You know, having clear optics on things is really necessary in a tight market like this. It's always necessary, but especially now because you're not getting that money back.
right, right. And sort of last question, and then I'll let you go. I know I've held on to you quite a while. One
I'm
topic.
enjoying myself, Elliot. We're good.
Okay.
Okay.
One topic in the multifamily space that I found incredibly interesting. I don't see much reporting on it this year, but certainly the last couple of years is the topic of redemptions. And sort of the notion of kind of paying the investor base back. And some of the bigger shops had to put it on pause. And I wonder, is that something you see continuing? And does that present a stronger opportunity for a firm like yours, um, where you're not as susceptible to that market force?
um, Anytime that there is any kind of a disconnect, that provides opportunity. And so, when we see these things happening, uh, and boy, are we dealing with so many unintended consequences of just the things that have been going on over the past several years, and including today. Um, and so, when it comes to um, um, people's rights, moving the market along, getting some transactional freedom.
Yeah,
I think that those things play into that favorably. All of these things. It's not one thing. It's going to be everything. So it does add to our optimism in the market and what we're looking at in one case. But on the other case, when we look at these things that are sticky or more troubled, um, um, unless we can get involved with some clear cut path, I don't like those for fishing.
yeah,
It's a waste of time. That's my roundabout way of saying I do believe that there will be opportunity, and I believe that'll be in the third and fourth quarter. Because if somebody can't pay for that time, they're not going to get it.
right. Well, time is money.
Elliot, you've been doing this. You've got a good overview of what the market looks like, and uh, when you see the players that are in the market today, there's a lot of people that really aren't known players, but they were given a lot of money.
Yeah,
And when you look at that money that was given to them, it was generally by people that were older and more sophisticated. And they are all in a box right now where they haven't been. And for somebody like myself who came from a CPA background, has weathered many, many cycles in this business,
yep,
The viewpoint is different. It's not a panic. It's not a day. It is a long-term commitment. It's what I love and what I do. My whole crew loves what we do, and as a result, I just see a lot of opportunity. Even in the last couple of years, a lot of people, such as ourselves, it gave us an opportunity really to focus on people in our company. We've recruited. This has been an unbelievable period to recruit. Um, and so, we've got we got a fantastic crew in my company, as a result of this time. We've developed property management. We have really developed an incredible investor portal that has more information than people want to know, but they haven't.
Yeah.
So all of this time that we've been working, where we were working on doing transactional deals and making those things work, we've really worked on the properties that we have. We've really worked on the company. We've really worked on our extended relationships with our investors, our people at our property managers and the maintenance crews. And so that's really what we took this time for. And that really was an opportunity in and of itself.
Yeah, that makes sense.
Yeah.
Well, from one real estate lifer to another, I appreciate your time, Neil.
Elliot, thank you for having me, and look forward to speaking to you again.
All right. Take care.
Thank you.